The dollar has been the world's reserve currency for over 70 years. It's the foundation of global trade, the anchor of central bank reserves, the currency that prices oil, gold, and nearly every commodity that matters. Trillions of dollars circulate outside the United States. Entire economies are built on the assumption that the dollar will hold value tomorrow, next year, next decade. But what if it doesn't? What if confidence shatters overnight? What if the currency that props up the global financial system suddenly collapses? Most people assume it can't happen. History says otherwise. And the consequences would make every previous financial crisis look like a rehearsal. Here's the thing about currency collapse. It doesn't require a war or a natural disaster. It requires one thing only: loss of trust. Money is not wealth. It's a claim on wealth, a promise that someone, somewhere, will accept it in exchange for something real. The moment that promise breaks, the moment people refuse to accept it, the currency dies. And the speed of collapse is terrifying because trust evaporates faster than it builds. Slowly, then all at once. So let's walk through what actually happens if the dollar collapses tomorrow. Not in theory, not in abstraction, but in concrete, step-by-step reality. Because this has happened before, to other currencies, in other countries, and the pattern is predictable. Day 1. Something triggers the panic. Maybe it's a debt crisis. The US government has over $33 trillion in debt, and that number grows every year. Maybe Congress fails to raise the debt ceiling and defaults on obligations. Maybe a major treasury auction fails because foreign buyers refuse to purchase US bonds. Maybe the Federal Reserve announces another round of money printing so large that even the mainstream media can't spin it. Maybe it's a geopolitical shock, a lost war, a fractured alliance, a sudden collapse in confidence. Whatever the trigger, the result is immediate. Traders dump dollars. The currency markets, which trade trillions per day, see a massive sell-off. The dollar plunges against the euro, the yen, the yuan, the Swiss franc. Within hours, the exchange rate has moved 10, 15, 20%. That's not normal volatility. That's panic. And panic feeds on itself. U.S. stock markets open and immediately hit circuit breakers, not because oil is scarce, but because oil is priced in dollars, and the dollar is collapsing. A gallon of gas that cost $4 yesterday costs $6 today. By tomorrow, it might be $10. Grocery stores start raising prices on anything imported: coffee, electronics, clothes, anything that crosses a border. Imported goods make up a huge portion of what Americans consume, and now they're all getting more expensive by the hour. Day 2. Banks see panic. People line up to withdraw cash, not because cash is safe, but because they want something tangible before the system locks them out. ATMs run dry. Banks impose withdrawal limits. This happened in Greece in 2015, in Cyprus in 2013, in Argentina repeatedly, in Lebanon in 2019. It will happen in the US if confidence collapses. Your money in the bank is not actually sitting in a vault. It's been lent out, invested, leveraged. The bank only keeps a fraction of deposits on hand. When everyone wants their money at once, the math doesn't work. The Federal Reserve announces emergency measures. Interest rates are slashed or raised, depending on whether they're trying to stop inflation or prevent a credit freeze. It doesn't matter. The problem is not interest rates. The problem is trust. The Fed's balance sheet, already bloated from years of quantitative easing, expands further as it tries to stabilize markets. But more money creation is exactly what caused the crisis. It's gasoline on a fire. Day 3. International fallout begins. Foreign central banks holding U.S. treasuries as reserves watch their assets lose value in real time. China, Japan, and European nations collectively hold trillions in dollar-denominated assets. If the dollar collapses, those reserves collapse too. Some nations try to dump treasuries before the losses get worse, which accelerates the dollar's fall. Others, trapped by the sheer size of their holdings, have no choice but to ride it down. Global trade freezes. The dollar is the currency used for most international transactions. If it's collapsing, exporters don't want to be paid in it, and importers can't afford the prices. Ships sit in ports. Supply chains, already fragile, snap. Countries that depend on imported food, fuel, or medicine face immediate shortages. Oil-producing nations refuse to accept dollars or demand payment in other currencies or gold. The entire inflation spirals. Prices for everyday goods double, then triple. Wages, tied to contracts and slow to adjust, fall hopelessly behind. A worker earning $50,000 a year finds their paycheck buys what $25,000 used to buy, then $15,000, then less. Real wages collapse. Savings evaporate. Anyone holding cash or cash equivalents, checking accounts, money market funds, watches their wealth vanish. The wealthy, those with assets, fare better. Real estate, stocks in companies with real productive capacity, commodities, these hold value better than paper. But the middle class, which holds most of its wealth in cash, savings accounts, and bonds, is obliterated. Retirement accounts, pensions tied to treasury bonds become worthless. A lifetime of saving, gone. Week 2. Social unrest begins. Protests erupt in cities as people demand action. The government responds with emergency measures, price controls, rationing, martial law in extreme cases. Price controls, as history shows, make shortages worse. If you cap the price of bread below what it costs to produce, bakers stop baking. Black markets explode. The official economy contracts, while the underground economy thrives. Political chaos follows. Blame is assigned. Some blame the Federal Reserve for years of reckless money printing. Some blame Congress for runaway spending. Some blame foreign adversaries for economic warfare. Some blame corporations for price gouging. It doesn't matter who's blamed. The currency is still collapsing, and blame doesn't fix that. Month 1. The international order fractures. The dollar's role as reserve currency is finished. Nations scramble to create alternatives. China pushes the yuan. Europe strengthens the euro. Some nations return to gold or barter agreements. A multipolar currency world emerges, chaotic and unstable. Trade between nations becomes a negotiation every single time. There is no universal medium of exchange anymore. The U.S. government, unable to borrow in its own currency at reasonable rates, faces a choice: slash spending or print more money. Slashing spending means cutting Social Security, Medicare, defense, everything. Politically impossible. So they print. And printing accelerates the collapse. Inflation becomes hyperinflation. Prices double weekly, then daily. By this point, the economy has reverted. Barter becomes common. Weimar Germany, Zimbabwe, Venezuela, Argentina, Hungary. Different countries, same script. The productive class survives. The paper wealth class is wiped out. Month 3. International implications stabilize into a new reality. The U.S. is no longer the global hegemon. Its military, dependent on a functioning economy, contracts. Bases close. Alliances fracture. Adversaries grow bold. The geopolitical order that existed since 1945 is over. China, Russia, regional powers all move to fill the vacuum. Inside the U.S., the standard of living has collapsed. Imports are minimal. The economy, once reliant on global trade, is now more localized. States and regions become more important than the federal government, which has lost the ability to project power without a functioning currency. Some states issue their own currencies or use alternatives. The United States, in all but name, begins to fracture economically. Now, let's be clear, this is not a prediction. This is a pattern. And whether it happens tomorrow, in 5 years, or in 20, depends on one thing: trust. As long as the world believes the U.S. will manage its debt responsibly, will not print recklessly, will maintain the rule of law and economic stability, the dollar holds. But that trust is not infinite. It is earned, and it can be lost. The warning signs are visible now. The national debt grows faster than the economy. Deficits are structural, not temporary. The Federal Reserve's balance sheet is still bloated from years of intervention. Inflation, once dismissed as transitory, proved persistent. Foreign nations are slowly diversifying away from dollar reserves. China and Russia have been reducing treasury holdings for years. The BRICS nations discuss alternatives to the dollar for trade. The foundation is cracking, slowly. So what should you do? First, understand that currency collapse is not theoretical. It has happened to every major currency in history eventually. The British pound, once the world's reserve, collapsed in influence after World War II. The Spanish real, the Dutch guilder, the French franc, all dominant in their time, all eventually fell. The dollar is not special. It is a fiat currency, backed by trust. Fourth, reduce debt. In a currency collapse, debt denominated in that currency can be inflated away, which benefits borrowers. But in the chaos before stabilization, credit markets freeze, jobs vanish, and servicing debt becomes impossible. Being debt-free gives you flexibility when systems fail. And finally, accept that the current system is not permanent. The dollar-dominated global order, the financial architecture built after World War II, will not last forever. Nothing does. The question is not whether it will change, but when, and whether you will be prepared when it does. History doesn't repeat, but collapse is never as far away as people think. The dollar has been the world's reserve currency for less than a century. That's a blink in historical time, and every reserve currency before it eventually fell. Confidence is the only thing holding it up, and confidence, as every collapsed currency proves, is the most fragile asset of all. If this made you think differently about your financial security, subscribe. The warning signs are already here. The question is whether you're paying attention.